Welcome to the Opening Bell Report.
All right, I want you to picture something for me, just for a second. We're going for a walk.
Okay.
But it's not just any walk.
Yeah.
We're in, the absolute best neighborhood in town. The one with the gated communities, heated driveways, lawns that look like they were manicured with nail scissors.
Right, the kind of place where the mailboxes probably cost more than my first car.
Exactly. And right in the middle of this block is the biggest, most impressive mansion. Historically, this is the premium property. It's the one everyone wants, but, nobody can afford because it always sells for a massive markup.
Mm-hmm.
But today, we walk by and there's a for sale sign. And the price. The price has been completely slashed. It's bargain bin pricing.
Which, that immediately sets off alarm bells. As a buyer, you're instantly wondering, okay, what's wrong with it? Is the foundation cracking? Is it haunted?
Right. And that is the central tension of the analysis report we're covering today. We're looking at this fascinating breakdown that argues the stock market is basically throwing the baby out with the bathwater on the mansion of the healthcare sector, UnitedHealth Group, ticker UNH.
It is a really compelling setup because UNH is typically what we'd call a compounder. It's a blue chip stock that usually demands a very steep price. So it's pretty rare to see it go on sale.
But right now, the sentiment is just awful.
Awful. The stock is trading at valuation levels we haven't seen since the absolute height of the COVID panic back in 2020.
And that's our mission for this deep dive. We've got this research report in front of us titled The 15x PE Opportunity. It's a heavy, strong buy recommendation, but let's be clear, this is a contrarian take.
Very contrarian.
While all the headlines are screaming about regulatory cuts and cyber tax, this analysis is screaming opportunity. So we're going to unpack the math behind this 15x number. We're going to figure out if the business is actually broken or just bruised and look at why they call this company a data fortress.
I'm ready. It really is a classic case of market psychology versus fundamental value.
So let's start with the math, because the title of the report, the 15x PE opportunity, that's doing a lot of the heavy lifting here.
It is.
For a listener who follows the markets, 15x might sound like a pretty standard number. The S&P 500 average bounces around, but 15 to 20 is a normal range. So why is 15x such a headline here? Why should we care?
Context is everything. You're absolutely right that for an average company, maybe a utility or some slow growth manufacturer, 15x earnings is a fair price. But UnitedHealth Group is it's not an average company. For the last decade, the market has treated it as best in class.
So it usually carries that premium price tag like a designer brand versus a generic one.
A pretty significant one. Historically, UNH trades at an average multiple of roughly 21.6x earnings. In the really good times, it'll bounce between 22 and 25x.
Wow.
So finding it trading down at 15x is essentially a 30% discount from its normal behavior. It's a statistical anomaly.
Okay, let's just verify those numbers from the report. Where are we getting this 15x from? Because, stock prices move every second, and I want to make sure everyone understands the calculation.
Sure. So the report breaks it down using the forward PE. And at the time of this analysis, the share price is hovering around, $260?
Okay, $260. Let's lock that in.
Right. Then we look at what the company's actually generating. Management's guidance for earnings per share EPS in 2026 is, conservatively estimated to be over $17.75.
Meaning for every single share I own, the company is pulling in $17.75 in pure profit.
Precisely. So you take that $260 price tag and you divide it by the $17.75 in earnings, and you get a multiple of roughly 14.6.
So we're just rounding up to 15x for the sake of the discussion.
Exactly.
That really is the equivalent of walking into a luxury car dealership and finding a brand new model priced like a used sedan.
It's the perfect analogy. And the entire thesis of this report relies on something called reversion to mean.
Which is just a fancy way of saying things eventually go back to normal.
Exactly. The bet is that UNH is not going to stay in the penalty box forever. And the upside calculation in the report is, it's pretty staggering. The analysis suggests that even if UNH doesn't go back to its high-flying days, let's just say it returns to a modest 18x multiple.
Which is still below its historical average of over 21. So we're not asking for a miracle here.
Right, very conservative. If you apply that 18x multiple to the $17.75 earnings estimate, the stock price mathematically has to jump to $319.50.
So we go from $260 to roughly $320.
That's about a 23% upside from where we are now. And that's just from the valuation correcting itself. That doesn't even count the dividend you get paid while you wait.
Okay, the math looks incredible on paper. It almost looks too easy. And this is where I have to play the skeptic. Stocks don't go on a 30% off sale for no reason. If I see that mansion selling for cheap, I assume the roof is leaking. The market isn't stupid.
No, the market isn't stupid, but it is incredibly emotional. It hates uncertainty. And right now, UNH is just swimming in it.
So let's diagnose the fear. What's got everyone so spooked? The report points to three main fear factors. Let's tackle them one by one, because we need to know if the house is actually broken. First up is margin compression.
Yeah, and this is the big scary chart in the report. If you look at UNH's net margins, they've dropped from around 6% all the way down to 2.7% recently.
Oh,
Right.
that sounds like a business falling off a cliff. I mean, if my profit margin gets cut in half, I am panicking. Why shouldn't investors?
It looks terrible in isolation, but you have to look at the why. The report argues very heavily that this is temporary noise caused by two specific events that just happened to hit at the same time.
Okay.
First, do you remember the Change Healthcare cyber attack?
Vaguely.
Yeah.
That was the hack that messed up payments for, like, all the hospitals.
No,
right?
it was massive. Change Healthcare is a unit of UNH that basically acts as the plumbing for the entire U.S. healthcare payment system. When they got hacked, the pipes just stopped working.
Oh, wow.
UNH had to spend a fortune to fix it, and they also had to front money to doctors just to keep the system running.
So that's a massive one-time expense.
Yeah.
It hurts the quarterly report, but it doesn't mean the business model itself is failing. Once the hack is fixed, that expense goes away.
Exactly. It's a shock, not a structural flaw. The second factor was a post-COVID spike in surgeries.
Ah, okay, this I've heard about. This is the idea that seniors who didn't get their knee replacements or heart surgeries during the pandemic all of a sudden went to the doctor at once.
That's precisely it. It's called utilization.
Mhm.
For an insurance company, high utilization is bad for short-term profits. You want people to pay premiums and stay healthy.
Right.
But suddenly, everyone was catching up on delayed care, so UNH had to pay out way more in claims than they expected.
But logically, that has to end at some point, right? You can only get your knee replaced once.
That is the analyst's entire point. The data in the report shows this is already normalizing. The backlog of surgeries is clearing. The cyber attack is resolved. These are temporary bruises, not a broken bone.
Okay, so fear factor 1 is basically bad luck and bad timing. Let's look at fear factor 2. This one feels a little more structural to me. Medicare Advantage cuts.
This is the regulatory headache. The government has tightened the funding rates for Medicare Advantage plans, which puts direct pressure on profits for insurers like UNH.
And since UNH is the heavyweight champion of Medicare Advantage, I mean, they have more seniors than anyone, this seems like a legitimate threat. If the government pays less, they make less. Simple as that.
It is a challenge, for sure. But the analysis brings up a counterpoint that I think is really, really insightful. It's the argument of scale.
How does scale help you when the government cuts your pay?
Well, think about it like the Walmart effect, or even Amazon. If the environment gets tougher, margins get thinner, compliance gets harder, who survives? The massive giant with the deepest pockets, or the smaller regional guys who are barely scraping by?
The giant survives. The small guys go out of business because they just can't absorb the hit.
Exactly. The report argues that while these cuts are annoying for UnitedHealth, they are potentially fatal for their smaller competitors. This could actually help UNH in the long run because as the smaller players fail or exit, UNH just scoops up their market share.
That is a brutal way to look at it. Basically, what doesn't kill me makes me larger.
It's the nature of capitalism in a highly consolidated industry. The hardest times usually lead to the biggest market share gains for the leader.
All right, fear factor number 3, the calendar. It's an election year.
The classic political risk.
I feel like every 4 years, healthcare stocks just get hammered because every politician gets on stage and promises to lower costs and go after the insurance companies. It's an easy applause line.
Oh, it creates a massive amount of noise. Investors hear the rhetoric, they see the angry ads, and they get scared that profits are going to be legislated away.
But the report suggests we should actually lean into this fear. That feels really counterintuitive.
History is on their side here. The data shows that healthcare stocks often underperform leading up to an election because of all the scary rhetoric. But, and this is the key, nothing usually happens that is as bad as the fear. If you buy during that peak regulatory fear, you often generate alpha, returns that beat the market once the election passes and the business just keeps chugging along.
So essentially the market is panicking about political speeches, but the actual machine of UnitedHealth just keeps printing money.
And that brings us to the most important part of this entire deep dive. We've talked about the math and the fears, but we haven't talked about what UnitedHealth actually is.
Right.
Because the report makes a very bold claim. It says we are wrong to think of this as just an insurance company.
Yes, I circled this phrase in the text. The report calls it a technology and data fortress. That sounds like something you'd say about Google or Microsoft, not a health insurer.
It does, but it's accurate. Most people know UnitedHealthcare. That's the card in your wallet. But the real jewel in the crown, the engine that drives this valuation, is Optum.
Optum. We see the name on buildings, but I feel like most people don't really realize how massive it is.
It is the key to their moat. This is where we get into vertical integration. UnitedHealth doesn't just pay the doctors. In many cases, they are the doctors.
Okay, let's break this down for the listener, because this is the secret sauce. How does that actually work? The report lists 3 pillars of Optum. Walk us through them.
Okay, first you have UnitedHealth. This is care delivery. They own clinics, urgent care centers, surgery centers. They employ tens of thousands of physicians.
So pillar 1, own the doctors. That's tangible.
Then you have Optum Insight. This is the data, the analytics, the tech side. They process billions of transactions. They sell software to hospitals and even to other insurance companies to help them manage payments.
Pillar 2, own the data.
And finally, Optum Rx. That's the pharmacy benefit manager. They negotiate drug prices, handle mail order prescriptions, all of it.
So pillar 3, own the pharmacy. Doctors, data, pharmacy, and insurance.
And when you put them all together, you get what the report calls the flywheel effect. Imagine a patient who has UnitedHealth care insurance. They get sick, they go to a clinic owned by Optum Health.
So UNH is paying itself. The left hand pays the right hand.
Correct. The doctor then prescribes a medication that's filled by Optum Rx.
UNH pays itself again.
And all the data from that visit is processed by Optum Insight to improve their risk models down the line.
So at every single step of the healthcare journey, the margin is staying inside the UnitedHealth ecosystem.
Exactly. This is total capture. If you look at competitors like Cigna or Elevance, they have pieces of this. Maybe they have a PBM and insurance, but nobody has the full loop of care delivery, data, pharmacy, and insurance at this scale.
That's the moat. Even if the insurance side has a bad year because of those Medicare cuts, the Optum side is there to catch the profit.
And the proof is in the cash flow. The report highlights this as the durability metric. Even during this quote-unquote disaster year, UnitedHealth generated over $19 billion in operating cash flow.
$19 billion. That is an immense amount of liquidity.
It proves the engine isn't broken. That cash flow is what secures the dividend. It shows that the business creates value regardless of the scary headlines.
It's amazing when you put it that way. You realize how disconnected the stock price is from the actual money machine underneath. It sounds like the market is focusing on the paint peeling on the outside of the house while ignoring the vault full of gold in the basement.
That is the definition of a value opportunity.
So let's look at the neighbors. The report has a comparison section. If UNH is the mansion, how does its price compare to the okay houses on the block?
Well, the premium has completely vanished. As we established, UNH is trading around 15x earnings. Now let's look at Elevance. The report rates them as medium quality, good company, but less integrated. They're trading around 12x.
Okay, so a slight discount, but not huge.
But then look at CVS. The report rates them as lower quality right now because they're struggling with their retail stores and execution. CVS is trading at 9x earnings.
So UNH is barely trading above the regular players and certainly nowhere near its historical premium.
The analysis argues that UNH is being priced as if it's just a commodity insurance player. The market is giving them zero credit for the high-margin, high-growth Optum business. It's like buying a smartphone for the price of a rotary phone because people are worried about the phone bill.
I love that image. So let's get to the verdict. The report rates this a strong buy. But this doesn't sound like a trade for day traders.
No, absolutely not. The strategy here is patience. This isn't a get-rich-quick trade for next Tuesday. The suggested time horizon in the report is 12 to 24 months.
And what's the buy zone? If I'm listening to this and I want to act, where does the analyst say the value is?
The report suggests accumulating shares in the $250 to $270 range, basically right where we're sitting now.
And what are we waiting for? What's the catalyst that makes the stock go back up? Because cheap stocks can stay cheap forever.
We're looking toward the second and third quarters of 2026. The thesis is that by then, the one-time costs from the cyber attack will have completely faded. The medical costs from the post-COVID spike will have stabilized.
So essentially, once the earnings reports start looking clean again, the market will wake up.
Exactly. The EPS power, that 1775 we talked about, will become undeniable. And suddenly, Wall Street will remember, oh, right, this is a premium compounder, and the multiple will expand back toward that 20x range.
But 2026 is a long way away. That's a lot of waiting. In the meantime, while we're sitting here waiting for the market to change its mood.
You have a safety net. The dividend.
Right. Let's talk about the yield.
Because the stock price is depressed, the dividend yield is historically high, around 3.3%. For a high-growth compounder like UNH, that is very generous. It effectively pays you to wait for the thesis to play out.
I think that's a crucial point for investors. It's psychologically so much easier to hold a stock that's down or flat when a check shows up in your account every quarter.
It absolutely is. It changes the psychology from I'm losing time to I'm accumulating income. It keeps you in the game.
So to wrap this up, let's go back to that opening image, the mansion with the broken window.
That really is the perfect metaphor from the report. Buying the best house in the neighborhood when it has a broken window is usually a winning strategy.
The report's conclusion is pretty stark. It says the market is pricing UnitedHealth as if it is permanently broken. But the data, the $19 billion in cash flow, the Optum integration, suggests it is simply bruised.
And bruises heal. Structural damage is hard to fix, but bruises heal with time.
It's a compelling argument. It really highlights how short-term thinking just dominates the market. Everyone's looking at the next quarter, worrying about an election that hasn't happened yet, while this massive money-printing machine is sitting there on sale.
That is usually where the edge is found, being willing to look out 2 years when everyone else is looking out 2 months.
So here is the question I want to leave you with today. We're in an election year. You are going to hear a lot of noise, see a lot of angry ads, and read a lot of scary headlines about healthcare. Do you have the patience to distinguish between a structural problem, like the business is actually failing, and a temporary sentiment problem where the market is just in a bad mood? Because if this report is right, the market's bad mood might be your biggest opportunity.
A very profitable question to ask.
Thanks for diving in with us today.
Always a pleasure.
Don't forget to like, share, and subscribe for more.